How are you, everyone? My name is Mr. J.M. Kimani, your lecturer in Management Accounting. Welcome to Lesson 2 of Standard Costing. Now, Lesson 2 will feature the variances. Now, what is a variance? Now, a variance is just a difference between the budgeted or the planned or the standard performance and the actual performance. That if the predetermined performance is different from the actual performance, there is a variance. This variance is either favorable or unfavorable. That if the actual performance is better than the budgeted or the standard, then that is a favorable variance. But if the standard performance is more than the actual performance, then that is an adverse or unfavorable variance. When we apply these to cost and incomes, we do have the cost variances and we do have the income variances. The cost variances, we can talk of the material cost, we can talk of labor cost, we can talk of overhead cost variances. That if these cost variances, if the actual cost is more than the budgeted cost, automatically that one become unfavorable or either adverse variances. But if the actual costs are lower than the predetermined cost, then that is a favorable variance. The opposite when it comes to the income variance, we have the sales variance. If the sales variance, if actually the actual sales is more than the budgeted sales, then that is a favorable variance. And if the actual sales is less than the budgeted sales, then that one is unfavorable variance. Now, having said that, we do have now variance analysis. We have variance analysis. Now, when we talk of variance analysis, this is just the evaluation. This is the breakdown of variances. That we can talk of the topmost variances or the entire variance, like now a cost variance. The total cost that we have spent against the total cost that we had predicted. That can be a cost variance. But again, we'd want to break down these. We evaluate that we can be able to tell exactly what is the reason and what bit of the variance can we deal with. So we could have different departments dealing with different things, and therefore we'd want to know exactly who made what variance, who is to be answerable. So it's because of that that we require to do some variance analysis. That you can break down this into now material variance. We can talk of labor variance, talk of overhead variance in terms of variable and fixed variances. And when we talk of the cost variance, we can break it down again into two parts. That we may have spent more or less because of the price of the item or the input that we have purchased and used. We may have a usage or either the talk of quantity variance because of using more or less of the input. So the price and the usage, or the price and the efficiency, those are the two variances that would explain the cost variance. When it comes to the income variance, we may also want to know whether this is because of the price we are charging the customers or it is about the quantity we are selling to the customers. So the quantity and the price. So these two again are going to explain the total sales variance. So you see now we are trying to analyze, and we can see that for each and every bit of variance has its own advantage and its own application. So instead of talking of the entire variance of the company, we can split this and break it down into specific variances which are going to be meaningful. Now, talking of the variance analysis, we may have some causes. It's just the general causes of variance analysis or variances. The general causes would be maybe the we have wrong budgets. That is, we may have faulty budgets. If you base your budgeting or calculations on faulty budgets, automatically you are going to have wrong differences or wrong variance. Let me say this. A wrong budget will yield a meaningless variance. So you need to keep updating your budget now and then so that at least you can have an updated budget. We can have wrong actual measurement. Now, for example, we can have wrong classification of items, like let's say hours. If you wrongly classify some direct hours or indirect hours, you put them as direct, you'll have overstated your actual direct cost or direct labor. And when you compare with a correct budget, then you have a wrong variance. But the reason is not because of the budget, it's because of the actual measurement. It is wrong because you have done some misclassification. So therefore, even the actual itself may be faulty. Not leave alone the budget, but even the actual itself may be faulty. And because of that, we would expect that kind of a difference. Then we also have failure to follow or implement budgets, or either failure to follow the prescriptions of the budget. That if the budget says that in the budget we had said that we use this material A and we end up using a different material, automatically we're going to have a variance. If we had prescribed we use more of the unskilled than skilled, then we came and used more skilled than unskilled, automatically we're going to have a variance. So failure to implement this is actually our biggest problem. And you know clearly that even practically, when you are given a dosage by a doctor prescribed there, you follow that the first few days, but after you feel better, you start having your own prescription. It's normal that we human beings are not able to follow and stick to the prescription. They end up adjusting the prescription, that if you never took the tablet in the morning, you forgot. So in the evening, you want to take double in place of the morning and now for that evening. So it's normal that in most cases we normally do some things not as budgeted. It requires discipline for you to follow what you had prescribed. You as students, you are so good when it comes to timetabling. If you look at the back of your exercise book, you've written there the timetable of what you'll be revising, how you'll be revising, what time you'll be revising, what unit you'll be revising. But do you follow that? How often do you follow that? Sometimes the timetable says that you need to be revising a unit, less like a unit like a management accounting. But the mood you have that time is of revising maybe a unit like, say, economics, a unit maybe like, say, taxation, or a unit like auditing, or such kind of unit that you have the mood that time. So you don't follow what has been laid down. So that is one of the reasons why we have the variances. We can also have some other random causes. These are not premeditated. These are just causes that will be there always. Whether you have the correct budget, the correct actual measurement or performance, everything is followed to the letter, you still may have some causes or some variances creeping in. That you do everything as per the prescription, everything is okay, but still you find there is that kind of variance. So that one, we say it is a random causes. Now, You may take the prescriptions as given by the doctor, but still do not get better. You may actually follow the procedures, the laid down procedures, but at the end there you do not get the desired and the targeted results. So these are causes that may not be explained in advance, but they are actually inherent in any comparison or in any performance. So these are causes. So these, among others, are the major causes of variances. Now, coming to the types of variances, So we are going to look at what we call the operational or operating variances. The operating variances. So in the name of talk of the material variances, talk of labor variances, talk of the variable overhead variances, talk of the fixed overhead variances. So material variances, labor variances, talk of variable overhead variances, and you have the fixed overhead variances. Now, and also we can have the sales variance also, sales variance or variances. These are what we'll be looking at, and then we break down now if it's material variance that. So I want to give you the structure of variances. So this is a structure of variances. That if you have number one, material variances, we can have what called the material cost variance. Now, the formula for material cost variance, this is MCV, is given by the standard quantity times standard price minus the actual quantity times actual price. This means standard material cost minus actual material cost. That if you do have the total of the material cost, you just need to compare. You don't need to do the computation as long as you have. Now, in the budgeting topic, we did what we call the flexible budget. It is from that flexible budget that we now extract the standard material cost. Otherwise, in the original or fixed budget, we do have what we call the budgeted material cost. But from the flexible, we can get the standard material cost. So even though we will not be preparing the flexible budget, but we'll be preparing the flexible component of that we want. Like if it's material, we prepare the flexible material cost. That's what we'll be calling standard material cost. And then we compare the actual material cost. Then this can be broken down and explained in form of these two variances. We have the material price variance, and we have the material usage variance. The material price variance and the material usage variance. That we do have, the formula is material price variance given by the actual quantity purchased. We multiply by the difference between the standard price and the actual price. While the material usage variance is the standard price in bracket, the standard quantity minus actual quantity used. Look at this. That we want to explain the cost variance in terms of price and usage. That tells you that if you are asked the causes of material cost variance, the major two variances are the And the major two causes are the price and the usage. Those are the major two.